start so we can try and keep to time. My name is Grant Buchanan. I'm a partner here at Scruth & Bland, heading up the financial planning department. And it's a great pleasure to welcome you to this, our latest Advisor Live series this morning. Now, to put it into context, Advisor Live it's somewhere between a webinar, a podcast, and a training session. And it's designed to be fairly short, sweet, and interactive as possible. Now, given the numbers of people we have in the call, and also the difficulty in trying to present and answer questions, I've got my colleague Matt Merchant joining me today, who's also one of our financial advisors. And down the right-hand side, you'll see that you will be able to ask questions through the presentation. Now, Advisor Live is designed to be interactive, so Matt will hopefully be able to answer some of the questions that are raised through the presentation. For anything that's not covered, we will follow up with at the end of the presentation. So Advisor Live is designed to be something that's timely, relevant, and easily digestible. And we set ourselves 3 ground rules with these seminars. We'll be doing them at least weekly or more frequently if there's matters that need to be dealt with more quickly than that. They'll last no more than 30 minutes, and we want them to be as collaborative as possible. So we will follow up on questions either during or after the presentation. And we hope that you'll find Advisor Live useful. And any feedback you have can be sent to hello@scruthandbland.co.uk. So today, what I'm going to be looking at is some market commentary based on the feedback we've had from some of our clients, and also how financial planning works in these uncertain times. I think also it's important for me to say from a compliance point of view that nothing that I'm going to talk about this morning should be taken as individual advice to buy a certain fund, product, or market. We're happy to gauge an individual advice on a one-to-one basis. But before we start the main presentation, one of the things that I really wanted to draw to everyone's attention is the fact that clearly we're living in very different times. We're operating under different circumstances, and people are worried about money, whether that's accessing bank accounts, pensions, investments, wherever it might be. Now, we recognise that we have to do things differently at the moment. For a lot of people, perhaps they haven't used telephone banking or online banking before, so they're looking for reassurance. Fraudsters, criminals are very much aware of this. And while some of us are very au fait with these technologies, some older clients or perhaps some inexperienced clients or vulnerable clients are not so comfortable with it. So I would certainly urge anybody with elderly relatives or vulnerable colleagues, friends, just to make sure that they take the time and seek proper guidance and are very careful when operating any of these mediums. I think the other thing to say is that we recognise that people are worried about money. And again, the criminals are very aware of that. So there's a lot of people out there, very sharp operators, peddling various schemes. The latest best thing, magic solutions to cure all the ills. Again, we're very, very cautious about anything like that. And certainly here at Scruth & Bland, we really base our advice on good, solid principles and nothing, certainly not silver bullet solutions. So today we're going to cover 3 main areas. First of all, a general market update covering the main markets. We'll talk about the importance of planning and behavioural finance. Then finally, we'll touch on cash flow modelling at the end. Now, when I was looking at putting this together and looking at the different markets, I think there is 3 key trends that go through everything we're doing at the moment. The first of those is clearly the time that it's going to take for this disease to be contained and mastered. That's something that we have to factor into everything we do. Second key trend is the global policy response. And the third thing we're aware of here is that there were pre-existing vulnerabilities in certain sectors and economies, and equally we see other areas where there's economic resilience. And those 3 trends will run through everything that I'm going to talk about today. So from a financial planning point of view, we know quite a lot about stock market crashes, certainly a lot more than we know about public health catastrophes. And this is the first time really since 1918-20, when we had the Spanish flu pandemic, that we've seen anything like this affect the world economy. But the fact that we might know about market crashes and market cycles, that doesn't really make it any easier to build an investment strategy to help us maneuver through these difficult times. We know that there's a cycle, whether it's economic or investment, but no cycle is quite the same as the last one. But we can perhaps look at some previous examples to help us through these difficult times. What can we say with a degree of confidence? Well, I think we can be reasonably sure, or absolutely sure, that there is going to be a recession, perhaps in a similar manner to that of 2008. But what we do know is that that's been met with massive fiscal and monetary boost that we'll see, hopefully, some of the edges of that taken off. The disruption this time is very different. If you look at what's happened this time, it's the real economy that has been frozen, and that is what we will have to revive. Back in 2008, it was a financial system that was almost destroyed and had to be rescued. But there's similarities in what will happen this time. I think the starting point really is that there will eventually be a recovery. We've seen enough cycles to know that that is what happened. Where we are at the moment is I don't think we really know enough yet to be certain of when that recovery happens, the strength of that recovery, or how durable the bounce back will be. Again, if you think back to 2008 and the depth of that crisis, it had been very hard to predict that that would be in the beginning of one of the longest growth periods and bull runs in equity markets. At some point over the summer, we would hope that the shape of the recovery will be clearer. Early indications that we've seen a bit of a V-shaped recovery, but it's perhaps too early to draw that conclusion entirely. We hope that the virus will start to recede over the summer, and we'll see the economic controls and freedom of movement will be lifted. And we'll see people going back to something of a new normal. I think the biggest concern we have is a reoccurrence. Will this virus come back? Hopefully we'll know more about the treatment, and we may even have a vaccine in time. At the moment, these are things that we simply don't know. But confidence will return, but the economy will be changed in ways that we can only predict at the moment. I think some sectors will be clearly much harder hit than others. If you look at simply the travel and tourism sector for a minute, that accounts for about 10% of the world economy. And I think it'd be reasonable to suggest that people will not be flying as often as they once did, and those sectors will take a long time to recover. I think also generically we will probably see that global trade might look a bit different, and companies will start to produce things a bit more locally. So all these structural changes will affect investment. But how do we translate that into investment strategy? Well, that's not very easy. And really, what we have to be doing is making sure that we get good diversification across portfolios and not concentrate our assets in one particular area. The economic map for 2020 and beyond is certainly far from clear. The markets have been resilient, and if you look at the FTSE dropping down below 5,000 at the depth of the crisis, it's now sitting up back near the 6,000 level. If we start looking at the UK, for example, as you say, that the downturn started on the 29th of February, and the trough to date was the 23rd of March. And we saw the FTSE all-share fall by 1,400 points, around about 34%. Now, clearly that loss was not locked in unless you sold at that point. Indeed, over the next few weeks, we saw the market rebounding by about 17%. So clearly, the key message there is not to panic. Unless you desperately need money, hold firm and wait for things to recover. I think if you look at the FTSE compared to other markets, it has underperformed, certainly in April. In April, there was a turn of just under 5%, but really that's quite easily explained by the exposure FTSE 100, FTSE all-share has to energy stocks. Clearly, we've seen massive government stimulus, including the furlough scheme, which seems to be supporting about 50% of UK adults at the moment. Now, I'm not going to talk through the various loans and job retention schemes. I know my colleagues have already done that, but there's clear commitment for the government to really do everything they can from a fiscal stimulus point of view to help us. I think that demonstrates the size of the problem. A lot of clients have been commenting about dividends. The UK market particularly has always been strong in dividends. Investors have become, if you like, used to a steady stream of income from their dividend yielding stocks. Now, that's clearly changed over the past few weeks. Most noticeably, we saw Shell reducing its quarterly payment for the first time since World War II. That's clearly due to the collapse of global oil prices and demand. So I think, not only will this affect Shell, I think we will see that affect other listed companies, and I think it'd be reasonable to expect income levels dropping for dividends, certainly over the next 12 months. Also, if we look at retail sales as another measure, they fell 5%, including food, but if you exclude food, it's a 20% drop in retail sales. So GDP, We haven't got any set figures yet on GDP, but certainly that's going to take a big hit. PwC are predicting that GDP will contract anywhere between 5 to 10% over the year 2020. I think we also have to recognise that there was a bit of a weakening in the economy even before this outbreak emerged. So what trends are we seeing? What the virus has really done is accentuate a number of the trends that were already there. And clearly one of those examples would be shopping, online services, retail. Traditional high street really is a shadow of its former self. If we look at the winners there, Amazon clearly has been a big winner, and we see that its quarterly sales rose 26% year on year. Now that sounds great, but actually their earnings growth hasn't been as strong as you would expect given those numbers. That's because even Amazon have had to adapt to this new way of working. They've had to adapt their working practices in light of the lockdown. The British Retailers Association has clearly been consulted and has issued some very stark warnings. And Andrew Goodacre suggests that 20% of retailers in the UK may never reopen the doors after lockdown. In terms of business, we've seen a lot of change in working practice. I think in the past we've used certainly technology, laptops, iPads and such like as perhaps luxury items, but by adopting technology, certain businesses have been able to adapt and work perfectly well from home. Certainly our own business here at Scruth & Bland, I would say 95% of what we used to do in the office, we can do just as effectively from home. And that resilience, that innovation is something I think we will see continue even when we go back to a new normal. However, there will be losers in this situation. If you think how technology has really hit certain industries in the past, particularly media, photography and films, for example, some of those companies and those sectors simply didn't adapt and didn't survive. So I think challenger businesses, those that adapt to technology, are the ones that will thrive. I think another trend we will see continue is investment into green infrastructure. I think that's a very strong message that's coming through from our clients. And indeed, that's certainly backed up by the European Union. Looking for outlook for the UK, well, I think the UK has been a bit unloved, particularly previously with Brexit. Even now, the performance due to the oil stocks has been disappointing, but I think the UK is well placed and resilient, and hopefully we'll see that recovery continue. One of the other key areas we've talked to clients a lot about is property. And when I talk about property from an investment point of view, I really mean commercial property. Before the virus, commercial property had a lot to offer investors, good income levels and good quality properties, and perhaps akin to or even better than some higher grade investment bonds. Clearly, one of the big advantages of property, particularly in the UK, is the fact that rent reviews always tended to be upwards, and we didn't see those rent reviews going backwards. However, there is a trade-off by investing in commercial property, particularly in physical commercial property funds, and that is liquidity. And if you think about that just for a second, that's because you're physically buying into bricks and mortar property funds. And clearly there's some very big chunky transactions in there. The liquidity problem only comes when people want to withdraw the money from these funds. Clearly, if everybody wants the money out at the same time, it's not there because it's invested in physical property. There are other ways to get exposure to property, such as property shares or using a REIT, but we've tended to favour the physical, commercial, real asset side of things. So we are seeing the property sector change. And some of those unwritten rules are perhaps being unwound. Rent reviews are now being brought forward. Many landlords are engaging with tenants and being forced to consider lowering rents, perhaps doing rent deferrals, or perhaps renegotiating leases. I think what we're seeing is that the balance of power is shifted from the landlord to the tenants. If you think about the collapse in demand for new space, particularly in the retail space, that's something that we're likely to see continue. As ever, as one area suffers, other areas do come to prominence. And perhaps in the past, industrial properties haven't been that attractive. But what we're seeing now is with the rise of online retailers, we don't want to be waiting 4 or 5 days for things to arrive to us. We expect them there the next day, possibly 2 days. And that has driven up demand for good, attractive industrial space that can be turned into warehousing for the likes of Amazon and online deliveries. So again, there are opportunities there. The office space clearly varies quite a lot, and that's another area that will look perhaps different after this crisis. But I think there will still be good demand from the right location and good quality offices in the right place. So I think we will see some property values fall, but again, this is where diversification is so important, and having a spread of both office, retail, and other commercial space. Moving on to government bonds, I think it's clear that the government will be issuing further bonds, and we will see in a minute they are a good diversification asset within a portfolio. The government has this intention to level up UK economic activity. We're likely to see them issue further bonds in the future. I think we'll see them issue bonds to support perhaps communications, energy, climate change, and even construction. Clearly, you're not going to get large returns from bonds, but actually as part of a diverse portfolio, you do add a balancing impact. Again, you need to be careful when selecting bonds. We tend to favour gilts, good quality corporate bond. Clearly, further down the risk spectrum, further up you go the risk spectrum, getting more adventurous returns, clearly there's a risk that those companies may default. Turning briefly to the US, the US operates very different to the UK. It's got a very different vibe to it. And if you look at what happened in the stock market, Donald Trump was very quick to jump on the new bull market. In reality, the US market dropped very, very quickly, but it did recover. And we saw April being one of the strongest months ever since 1987. I think, again, the federal response has been huge. The federal debt has risen to about $6.7 trillion, which is just huge. And to put that into context, that's about 26% of expected 2020 GDP. I think looking at the US, although there has been a bit of a V-shaped recovery to date, I think that there's other strategic problems that we need to be aware of, and that's particularly in the labour market. The US is very quick to fire employees, and the unemployment rate is likely to only increase as we go through this period. And the reason that's really important is the US economy has largely been filled by consumer spending. So I think that's something that the US is very much aware of and will have to change. And we can see that they're likely to move to a much more investment-driven situation, looking at investing into housing, manufacturing, and certainly changing their ideology from low-tech to high-tech. I think Trump's made it very clear that rather than looking at offshoring solutions, they're very much more likely to be bringing a lot of work back onshore to the US. Looking at Europe very quickly, Italy was clearly the epicenter of the outbreak in Europe, but we are seeing Europe starting to open its doors and go back to an element of normality. There's been a decreasing and an opening up of businesses in both Italy, Spain, and Germany, but there's no doubt Europe has been hit hard. Again, perhaps Europe's a bit slower to adapt to some of the technology and working practices we have been in the UK. And Europe does have a very high exposure to global trade, particularly China. So these combining factors meant that the Eurozone was hit hard. We saw declines of about 35% in some of the indexes middle of March. Eurozone GDP contracted by 4% in the first quarter, and we'd expect the second quarter to be even bigger. I think there's some more bad news to come there. And the IMF is indicating that a drop of somewhere in the order of 7% in GDP over 2020, and it's likely we'll see a big increase in deficits and debt levels. That is something the European Central Bank is very much aware of. And even before this crisis, there was some concern about some of the Italian banks, and the ECB are aware of that, and they've been busy buying up bonds, particularly in Italy and Spain, to try and provide some reassurance. We've also seen the ECB easing the ability for companies to borrow money to help support small and medium-sized enterprises. And that's helped. We have seen a bit of a bounce back in Europe with the MSCI index up over 6% over the period of April. So I think there's signs that that activity is working. I'm sort of conscious of time, just touching on China quickly. Again, very different economy, first to be affected by the virus, clearly locked it down extremely well. And I think perhaps it's always difficult to get perhaps the true data, but we can look at some of the trends that we've seen in China. What we have seen is that traffic levels are starting to get back to normal. Businesses are starting to operate, and we can measure that by things like coal consumption, power generation. That's starting to get back up to somewhere near normal levels. However, the government have had to step in and assist with some large fiscal support. The People's Bank of China cutting interest rates and encouraging banks to lend money. I think it's not all good news. If we look at some of the information around cinemas and restaurants, those sort of types of businesses haven't gone back to life as normal. They're still very much restricted, and people are nervous about going to them. Again, whilst we're seeing a bit of a V-shaped bounce back in China, I think whether that's sustained or not, we'll have to wait and see. So moving on to one of the areas that clients are concerned about is cash, particularly when we've had banking crises in the past. People are still nervous about cash. We need to hold cash. Everybody needs some cash. I think the banking system this time is much better capitalized, much better resourced, so we don't fear too much about the banks at the moment. For anyone who is worried, clearly it doesn't make sense to have more than 85,000 in one bank. And if you are really concerned, you can invest via NS&I, which is 100% government backed. So as long as the UK government is okay, your money's protected. We've also seen a rise of cash management solutions to help spread money around. Touching on inflation, I think this is something we perhaps need to keep an eye on as we emerge out of this crisis, because again, looking at history, when governments have been faced with large amounts of debt, they have two main ways to get out of it. You either have years of austerity and underinvestment in the economy, or you perhaps inflate your way out of it. I don't think either of those two things will be very popular at the moment, and certainly the government, having just borrowed a lot of money, are unlikely to want to rise and have high interest rates anytime soon. But I think there'll be a new norm where perhaps we'll just need to get used to those higher debt levels. I think that's something that we'll see continue over the next few years. So moving on, one of the things that's important is diversification, and I think we can put a chart up just to show how the asset classes we've been investing in for an average portfolio have performed over the past year. What you can see on that chart is that there has been that V-shaped bounce across all those asset classes, but very much those that are designed to be defensive have done their job, and we can see equity markets having been hit hardest. Why is this important? Well, at the moment, we can talk about markets, we can't control them, and it's very hard to predict them. So a lot of the work we're doing is around behavioral finance. If you think about this, clients have become very used to strong market performance. Certainly after 10 years of fairly loose monetary policy and a record bull run in equity markets, people perhaps just get used to good returns. The reality is that during any life of any portfolio, you do expect it to be good, bad, and in different years, and it's easy to forget that. I think when we're working with clients, the most important thing is to put a plan in place. Make sure that your plan is robust, well diversified, and you continually review it. So for example, as I said earlier, if you'd sold at the worst point of the markets, you could have seen a 34% decline. But if you didn't need to sell, we have seen things recover. And actually, if you're investing for the long term, you may not need to do anything now. Clearly, that position might be different for some people if they've been made redundant, or they perhaps need to look at generating income to replace some employment income. But for the majority of people, actually doing nothing could well be the right thing to do as we wait to see how all these things come to the fore. I think talking about behavioral finance, we can see that as markets are cycles, people's emotions also play into this. And that's a lot of what we're doing with clients is trying to reassure them, talking to them and engaging through this period. When markets are good, we get over-optimism, we get over-confidence. In the second stage, we have this complacency where people get used to everything going well. And where we are at the moment is a lot of panic, a lot of capitulation and despondency. And that's something we've got to be aware of. But actually, that's the point where there is a maximum opportunity. If you can invest at this point, you perhaps buying something at a much lower price and hopefully get better returns on the way forward. And the way we've been doing this with clients really is trying to show in real terms whether the plans remain on track. Just talking about markets and performance and inflation and returns, it's quite difficult for a lot of people to quantify. A number of my colleagues have already talked about the importance of business having cash flow projections. And what does cash flow look like over 3, 6, 9, 12 months? And actually, it should be very much the same when it comes to personal financial planning. So we've got some simple examples just to demonstrate this. And we based this on a client who is in the mid-50s looking to retire at 67. Their income currently meets their expenditure, but in retirement, there's a 30,000 shortfall. We've made some realistic assumptions on returns and inflation, and they have around about 500,000 in pension and investment assets. The first chart is a very simple one, and it's showing just simple linear growth. Arguably, it's not that useful because I think we all recognize that portfolios don't simply go up in a linear manner. They do vary. But what that was showing is that actually, by the time they get to 67, their assets have grown. And then when they start to draw on those assets, even by the age of 99, when we've assumed that they die, there was still a pot remaining of 468,000. So to make that a bit more realistic, what we then said was actually, that's not how investments work. So we used historic market data over the period 1990 to 2019, based on an averaged, balanced portfolio. And that still achieved some very strong growth, but clearly it varied much more over that period. And the net result of having variability showed that when you start to draw on the money, if the portfolios were going down, that has a doubling up effect. So it's the opposite of pound cost averaging. And by the end, in that second graph, you can see that the portfolio at age 99 still had a residual value, but it was reduced to 324,000. Perhaps the one that's most relevant, and we're doing a lot more of, is saying that actually, what happens if there is a market crash, particularly when you start to draw on your benefits, because that is the worst time for these things to happen. And that's something we can model and show clients that actually what is the real effect to them of this happening. So we did that in the final example, and we used the stock market crash data from 2007 and 8. And what that shows is that they still had a good portfolio at retirement, but by the end of the forecast, they had run out of money. And that is that effect of that doubling up of the effect of drawdown and portfolios going down. So hopefully that's been a useful update in the markets and some of the things we can and possibly help with to give reassurance to clients. I think just in summary terms, whilst we recognise that these are uncertain times and difficult times, the only way to generate real returns from investments and pensions is by investing in real assets. And that's something that's backed up by the 2019 Barclays equity study that showed that back in 1899, if you invested £100, that would have grown to 2.7 million. Well, that's a bit unrealistic. But what does that mean in real terms? Adjusting for inflation, that's a 4% annualized return. I think that's the only way we can get real returns on money, by investing in underlying real assets. Thank you very much for your time today. Hopefully that's been useful, and we're happy to deal with any questions.